The most important bond market on Earth just sent a warning signal that almost no one was prepared for. And if you think this is just another Japan story you can safely ignore, you are about to be very surprised. When Japan's 30-year government bond yield surged to 3.5%, it wasn't just a number on a screen. It was a crack in the foundation of the global financial system. This is the kind of move that doesn't make headlines until it is already too late, and by the time most people notice, the damage has already spread. For decades, Japan has been the definition of stability in global finance, the country of near-zero interest rates, endless bond buying, and a central bank that promised to do whatever it took to keep yields under control. Japanese government bonds were treated like the quiet corner of the market, where nothing ever really happened. The place where pension funds, insurers, and global institutions could park trillions without fear of violent moves. That belief is now being challenged in real time. A 30-year yield at 3.5% may not sound dramatic if you are used to volatile stock charts or crypto swings. But in the world of long-duration sovereign debt, this is seismic. It is like watching a glacier suddenly start moving at highway speed. To understand why this matters so much, you have to understand Japan's unique role in the global system. Japan is the largest creditor nation in the world, meaning Japanese institutions own massive amounts of foreign assets, including US Treasuries, European bonds, and global equities. For years, the entire strategy was built on borrowing cheaply at home and investing abroad for higher returns, a trade known as the carry trade. When Japanese yields were near zero, this made perfect sense. Borrow in yen at almost no cost, convert it, and buy higher-yielding assets elsewhere. But when long-term Japanese yields spike, the math behind that trade starts to break. And when the math breaks, leverage becomes dangerous. A 30-year bond yield represents expectations about inflation, growth, and trust in a government's ability to control its finances over an entire generation. When that yield jumps, it tells you investors are demanding much higher compensation to lend money for that long. In Japan's case, this is especially shocking because the country has lived with deflationary pressure for most of the last 30 years. The Bank of Japan built its entire identity around suppressing yields through yield curve control, a policy where the central bank explicitly capped how high bond yields were allowed to go by buying unlimited amounts of bonds if necessary. That policy worked for years, but it came at a cost. The BOJ ended up owning more than half of the entire Japanese government bond market, distorting price discovery and liquidity. Now imagine what happens when the market starts to push back. As yields rise, the price of existing bonds falls. That means massive unrealized losses for anyone holding long-duration debt. Japanese banks, insurance companies, pension funds, and even the central bank itself are exposed to this risk. These institutions are not traders flipping bonds every day. They are long-term holders who rely on stability. A rapid rise to 3.5% on the 30-year forces them to reassess risk models that were built, on the assumption that yields would stay low forever. This is where the idea of a global margin call begins to make sense. A margin call is not just something that happens to day traders. At the institutional level, it means collateral suddenly isn't worth as much as it used to be. Bonds that were once considered pristine collateral lose value, forcing institutions to either post more collateral or sell assets to cover the gap. When this happens across the system at the same time, selling pressure spreads into other markets. That is how a move in Japanese bonds can ripple into US Treasuries, European debt, equities, and even commodities like gold and silver. Another layer to this story is the currency. Rising Japanese yields tend to strengthen the yen because higher yields attract capital back home. A stronger yen may sound positive, but it creates stress for global markets that are built on a weak yen assumption. Many hedge funds and institutions have borrowed yen to fund investments elsewhere. When the yen rises, those positio ends become more expensive to maintain, forcing unwinds. Unwinding a carry trade means selling risk assets and buying back yen, which tightens global financial conditions. This is how something that starts in Japan can end up shaking markets thousands of miles away. Historically, some of the most violent global market events have started with moves in the bond market, not stocks. The bond vigilantes of the 1990s, the taper tantrum in 2013, and the UK gilt crisis in 2022 all began with yields moving in ways policymakers did not expect. Japan was supposed to be immune to this kind of shock, the last place where yields would lose control. That illusion of control is now fading. When the longest bond on the curve breaks higher, it signals that investors no longer fully believe the central bank can keep inflation and debt dynamics contained over the long term. This is where precious metals quietly re-enter the conversation. Gold and silver are not just inflation hedges, they are confidence hedges. They respond not only to rising prices, but to declining trust in financial promises. When long-term sovereign bonds become volatile, the idea of a risk-free asset starts to feel questionable. Gold does not default. Silver does not require a central bank to defend it. Historically, periods of bond market stress have often coincided with renewed interest in hard assets, especially when real yields become uncertain. Think of the global financial system like a massive suspension bridge. For ours, Japan's bond market was one of the main support cables, steady, predictable, and taken for granted. When that cable starts to vibrate, the entire structure feels it. The move to 3.5% on the 30-year is not just about Japan's domestic economy, it is about the pricing of time, risk, and trust across the world. Investors are being forced to confront a reality they have avoided for years, that ultra-low rates were an anomaly, not a permanent feature of the system. As we move forward, the critical question becomes whether this is a temporary spike or the beginning of a structural shift. If yields remain elevated, Japan may be forced to choose between defending its bond market with even more aggressive intervention or allowing the market to reset at much higher levels. Either choice carries consequences. Intervention risks further weakening the currency and stoking inflation. Allowing yields to rise risks destabilizing institutions that were never designed for this environment. This is the dilemma at the heart of the current moment, and it is why markets around the world are watching Japan more closely than they have in decades. Because what happens next will not stay contained. It will spread, and it will matter to everyone holding paper promises in a world that is starting to reprice risk right now. The consequences of that repricing begin to show themselves in places most people are not watching yet, because global markets are deeply interconnected in ways that are Why to forget during long periods of stability? When Japanese yields surge, it doesn't stay a local event. It forces a recalculation everywhere that Japanese capital touches, and that is almost everywhere. Japan is one of the largest holders of US Treasuries in the world, and Japanese institutions have historically been steady, price-insensitive buyers. They bought treasuries not because yields were attractive, but because they needed somewhere liquid and safe to park excess savings. That assumption starts to change when domestic yields suddenly look competitive. If a Japanese insurer can earn 3.5% by holding a domestic government bond without currency risk, why would it accept similar yields abroad with added volatility and FX exposure? This is where pressure quietly builds in the US bond market. Even small shifts in Japanese allocation decisions can move yields globally because the volumes involved are enormous. When yields rise in the US as a result, bond prices fall, and that feeds directly into everything from mortgage rates to corporate borrowing costs. This is how a move in Tokyo can make it more expensive to buy a home in Texas or finance a business in Europe. At the same time, higher global yields tighten financial conditions for banks. Banks hold bonds as assets on their balance sheets, and when those assets lose value, capital ratios come under pressure. We saw a preview of this dynamic during the regional banking stress in the United States when unrealized losses on long-duration bonds suddenly mattered. Japan's yield spike adds another layer of stress, especially for institutions that assumed long-term bonds would remain stable anchors. This is not about insolvency overnight. It is about confidence and liquidity. When markets sense stress, they demand more collateral, shorter maturities, and higher premiums. Equities feel this pressure indirectly but powerfully. Higher long-term yields raise the discount rate used to value future earnings. Growth stocks, which depend on profits far in the future, are especially sensitive. When yields jump, those future cash flows are worth less today, even if nothing about the underlying business has changed. This is why bond market moves often precede equity volatility. Stocks don't crash because yields go up one day, they struggle because the entire valuation framework shifts underneath them. Now add leverage into the picture. Hedge funds, private equity, and large institutions use borrowed money to amplify returns. That leverage is tied to collateral values. When bonds fall and currencies move, margin requirements rise. Suddenly, positions that look safe become risky. This is where the term global margin call becomes more than a metaphor. It doesn't mean one dramatic phone call. It means thousands of quiet adjustments happening at once. Forced selling here, hedging there, positions reduced not because managers want to, but because they have to. This environment is particularly challenging or carry trades. For years, borrowing in yen was almost free, and that cheap funding was the grease that kept many strategies running smoothly. As yields rise and the yen strengthens, that grease dries up. Unwinding carry trades often happens quickly and violently because everyone rushes for the exit at the same time. This can amplify moves across asset classes, pushing down equities, widening credit spreads, and increasing volatility in commodities. This is where gold and silver often behave differently from what many expect. Precious metals are not immune to volatility, but they tend to respond to shifts in confidence rather than earnings or growth projections. When real yields become unstable and currencies fluctuate, investors look for assets that are not someone else's liability. Gold, in particular, has historically performed well during periods when bond markets are under stress and central banks appear constrained. Silver adds another dimension, because it is both a monetary metal and an industrial input, linking it to economic activity as well as monetary sentiment. Think about it this way. Bonds are promises about the future. Stocks are expectations about growth. Precious metals are reflections of trust in the system itself. When the plumbing of the financial system starts to creak, trust becomes a central variable. Japan's yield shock raises uncomfortable questions about debt sustainability in a world where rates are no longer near zero. Japan's debt-to-GDP ratio is one of the highest in the world, yet it functions smoothly for decades because borrowing costs were suppressed. When those costs rise, even slightly, the arithmetic changes. This doesn't mean Japan is about to default or collapse, but it does mean the margin for error is thinner. Governments around the world are watching closely because they face similar dynamics, high debt levels built during years of cheap money. If the market begins to demand higher compensation for long-term lending, fiscal choices become more constrained. That can lead to higher taxes, reduced spending, or increased money creation, none of which are neutral for markets. Another overlooked aspect is liquidity. The Japanese bond market has been heavily distorted by central bank ownership. When yields move quickly, liquidity can dry up, making price discovery more violent. Illiquid markets tend to overshoot in both directions, creating sudden spikes that force reactions elsewhere. This is why policymakers fear disorderly moves more than gradual adjustments. Once disorder sets in, confidence can erode faster than any central bank can respond. History offers lessons here. In past cycles, bond market stress often preceded policy pivots. Central banks talk tough until markets force their hand. The question now is whether the Bank of Japan can maintain control without exporting volatility to the rest of the world. Any attempt to cap yields aggressively could weaken the yen further in the long run, reigniting inflation pressures. Allowing yields to rise risks domestic instability. There is no painless option. For everyday investors, this moment challenges long-held assumptions. The idea that bonds are always safe, that diversification alone protects portfolios, and that central banks can always smooth out volatility is being tested. This does not mean panic is warranted, but awareness is essential. Understanding how these pieces fit together helps explain why headlines that seem distant matter deeply. As these pressures build, attention naturally turns to assets that sit outside the traditional financial structure. Gold and silver ownership rises not because people expect instant profits, but because they want insurance against systemic stress. It is the same instinct that drives people to diversify supply chains or keep emergency savings. Precious metals function as financial shock absorbers, not growth engines. The key takeaway so far is that Japan's 30-year yield is not an isolated statistic, it is a signal that the era of artificially suppressed long-term rates is under strain, a signal that leverage built on those assumptions is vulnerable, and a signal that markets may be entering a phase where volatility is not an anomaly but a feature. As this adjustment continues, the next stage will depend on reactions from policymakers, investors, and institutions around the world, because once trust in the longest promises begins to wobble, the system looks for new anchors, and that search is only just beginning, especially as we move into the next phase where everything converges on one unavoidable question: what happens when the world realizes that time itself has become more expensive and the bill is coming due? Next, the global financial system faces a crossroads where every market participant, from central banks to retail investors, is being forced to rethink risk, return, and the assumptions that have underpinned decades of stability. The shockwaves from Japan's 30-year yield reaching 3.5% are not theoretical. They are being felt in real time across equities, bonds, currencies, and commodities. Institutional investors are reassessing balance sheets, hedge funds are adjusting leverage, and pension funds are calculating new liabilities, all while central banks weigh intervention against the long-term consequences of distorting markets further. The interconnectedness of modern finance means that a move in Tokyo instantly affects pricing in New York, London, and Frankfurt. creating a cascade where uncertainty in one corner of the world amplifies volatility everywhere else. One critical channel of transmission is US Treasuries. Japanese institutions are among the largest holders of US government debt, and even small shifts in their appetite can influence yields and liquidity. As Japanese yields rise, the incentive to keep money parked abroad diminishes, prompting adjustments in portfolios that push up borrowing costs globally. Higher yields in the US and Europe increase the cost of capital for governments, corporations, and households, creating a feedback loop that can slow growth and heighten market anxiety. This is compounded by currency movements. A strengthening yen makes foreign assets less attractive, forcing repatriation of funds and tightening global liquidity, which in turn can exacerbate market stress in riskier assets. Equity markets are particularly sensitive to this recalibration because higher long-term yields directly affect the valuation of future earnings. Growth stocks, technology sectors, and high-duration assets experience sharper declines because the present value of their anticipated cash flows decreases. Even large-cap value companies are impacted indirectly as rising borrowing costs and tighter credit conditions slow expansion plans. Volatility spikes, correlations between asset classes change, and previously reliable diversification strategies are tested. Investors may find that traditional hedges no longer behave as expected, prompting a rotation into perceived safe havens like gold, silver, and other tangible assets that are less exposed to financial market assumptions. The ripple effect also extends to credit markets. Corporations that borrowed heavily during years of ultra to low interest rates now face refinancing risk. When yields rise and bond prices fall, leveraged loans and corporate bonds become more expensive, increasing the probability of defaults in marginally financed companies. Credit spreads widen, investors demand higher risk premiums, and a tightening cycle accelerates. Banks, which hold both corporate and sovereign debt, must manage these losses while maintaining regulatory capital ratios, further compressing their risk appetite and influencing lending behavior, which directly affects economic activity and investment decisions. For everyday investors, this complex web of interactions underscores the importance of understanding macroeconomic signals and structural vulnerabilities. Precious metals like gold and silver become not just investment options but strategic tools for wealth preservation. Unlike bonds or equities, these assets carry intrinsic value, are free from counterparty risk, and have historically served as reliable hedges during periods of systemic stress. Their performance during past bond market disruptions, currency crises, and inflationary episodes illustrates how tangible assets provide a psychological and financial anchor when confidence in financial promises wavers. Looking historically, market crises triggered by sudden changes in sovereign bond yields are neither rare nor trivial. The taper tantrum of 2013, the UK gilt crisis in 2022, and emerging market shocks in the late 1990s all began with a recalibration of what investors demanded for holding long-term government debt. Japan's yield surge is a stark reminder that even the most seemingly stable markets can transition from calm to volatility in a matter of days. The fact that this is occurring in a nation long associated with low rates and careful monetary management only amplifies its significance, challenging long-held assumptions about central bank omnipotence and the predictability of bond markets. Policy decisions from the Bank of Japan and other central banks will be decisive in shaping how the rest of the world responds. Aggressive intervention to cap yields could temporarily suppress volatility, but might weaken the currency, fuel inflation, and perpetuate long-term imbalances. Conversely, allowing the market to recalibrate naturally could stabilize confidence in the pricing mechanism but risk destabilizing institutions heavily exposed to long-term debt. The delicate balance between intervention and market discipline defines the central challenge, and the timing, scale, and communication of policy actions will determine whether this episode is a contained shock or the beginning of a more extensive global repricing. The human element is equally important. Investors, fund managers, policymakers, and households all make decisions based on perception as much as fundamentals. When a market believed to be predictable suddenly behaves unpredictably, fear, uncertainty, and doubt spread. That psychological component can amplify technical movements, triggering additional selling.
If you opened your terminal this morning and checked the silver futures tape,
recognizing this feedback loop is crucial for anyone navigating the current environment,
You saw evidence
emphasizing
of a
the need
financial
for clear
execution
straw.
that was planned months ago.
Teggies,
And nobody on CNBC is going to
diversification
tell you
across
what you
asset
are actually
types,
looking at.
and an
The
understanding
spot
of
price for
systemic
silver on the COMEX
interdependencies.
screen is showing $30
Japan's 30-year
per
yield hitting
ounce.
3.5%
That number is a
not merely a
fabrication.
domestic
It is a
financial
mathematical
event.
impossibility
It is a global
when you
signal of shifting
reference it
expectations
against
about
what is
risk,
happening on the ground in
return,
Shanghai,
and
in
trust
Moscow,
in the financial
and across
system.
the entire
It
Eurasian
has
rail
immediate
network that connects them.
implications for U.S. and
What you
European
are watching
bonds,
in real
equities,
time
currencies,
is the
and credit
complete
markets,
decoupling of the
while
paper
also
silver
influencing
market from
portfolio
physical
decisions
reality.
across the globe.
And the trigger is not
The
a
resulting
crash.
volatility
The trigger is a
underscores
train,
the
an actual freight
interconnectedness of
train,
modern
multiple
finance and
freight
highlights
trains,
the importance
a
of
convoy of
tangible
rail cars
assets,
moving
like precious
200
metals
metric
as anchors
tons of
during
Russian
systemic
silver per
stress.
year directly into
Investors,
Chinese
policymakers,
manufacturing
and
facilities,
institutions
completely
must adapt to
bypassing
this
every
new
aircraft
reality.
carrier. Every destroyer, every naval blockade that the
recalibrating
United
risk
States
models,
Navy
and
has spent
preparing for a
70 years
world
building
where
to control
long-term
global
interest
commodity
rates
flows.
are no longer a
And the
guarantee of
timestamp on this
stability.
trade